Good morning, students. Welcome you again on this video lecture on this live virtual classes organized by Board of Studies of ICAI. So I am C. Alok Garg. Today we are going to discuss about another standard which is Ind AS 23 borrowing cost. So first question I would like to ask to all of you whether this standard borrowing cost. So borrowing cost, as the name suggests, it seems that it's like a nominal account. I mean to say it is like an expense account. So what is the nature of this standard? If I need to classify this standard, so is it a expense related standard or is it a asset based standard? Can any of you tell me? Is it a asset based standard or is it a expense related standard? So technically speaking, borrowing cost. So as the name suggests, borrowing cost should charge to P&L. Borrowing cost should charge to P&L. So why this standard is here? So this standard talks about exceptions to the borrowing cost. I mean to say exceptions to the situation where the borrowing cost should not charge to P&L. So if it will not charge to P&L, then where the borrowing cost will go? So borrowing cost will be capitalized. So this standard talks about the situations where the borrowing cost needs to be capitalized. What does it mean? It means borrowing cost should form part of the cost of the asset. Again, it means we are talking about or we are going to discuss about one more asset related standard. So far, we have discussed Ind AS 16 property, plant and equipment, Ind AS 38 intangible assets, Ind AS 36 impairment on such assets, Ind AS 40 investment property, then yesterday Ind AS 2 inventories, and now it is Ind AS 23 borrowing cost. So this standard talks about the borrowings which have been incurred on such assets like property, plant and equipment, like intangible assets, like your investment property, like inventory. So if the borrowing has been incurred on such assets, then that borrowing cost will form part of that particular asset, or that borrowing cost will be capitalized if some condition would be met. Okay, so we will discuss about those conditions. If you remember, when we discussed Ind AS 16, when we discussed Ind AS 38, when we discussed Ind AS 40, we discussed that deferred settlement terms, and in that deferred settlement terms, we discussed deferred credit period. We discussed that this interest cost will be capitalized as a part of the cost of the asset if this Ind AS 23 conditions will met. Okay. So in nutshell, we are talking about one more asset related standard. So as the name suggests, borrowing cost, it is of course seems like a P&L amount, seems like a P&L item, but it is not a P&L item. It is not a nominal account. In this standard, we are talking about this item to be capitalized as a part of the cost of the asset. Okay. So now, as usual, I have to tell you what is the structure of this entire standard. Then we will take it forward one by one. So first of all, we will be discussing main principle, or rather I would say objective. Okay. I hope the whiteboard is visible to all of you and my voice is also clear to all of you. Please confirm. Okay, so many students have replied also that it is an asset related standard. It means that my voice and whiteboard, so everything is audible and visible. Great. So main principle, we'll discuss what is the main principle of this standard. Then we will be discussing, of course, scope, where this standard will be applicable, where this standard will not be applicable. Then we will be discussing borrowing cost eligible for capitalization. Borrowing cost eligible for capitalization. Eligible for capitalization. In the borrowing cost eligible for capitalization, we will discuss the concept of specific borrowing. I mean to say, what will be the accounting treatment when the company will have specific borrowing. For example, you are taking a home loan. So you are taking a home loan for a specific home, okay, for a specific house, for a specific property. So this is known as a specific borrowing, the borrowing which have been incurred specifically for a particular item, okay. Then we will be discussing general borrowing. Okay. So what is meant by general borrowing? The borrowing which have been made generally and some amount has been utilized for the construction of the asset. We'll discuss all these concepts one by one. Just I am giving you a flavor. Then we will discussing capitalization rate. How to calculate this capitalization rate. We'll discuss this part also. Then we will be discussing the period of capitalization. The period of capitalization. Period of capitalization. If you see the structure, everywhere we are talking about the capitalization. We are talking about the capitalization. We are not talking about the expense, because the general rule is that borrowing cost should go to expense. But in this standard, we are only talking about the exceptions. Means it will not go to P&L. It will go for the capitalization. Okay. So period of capitalization, in this part, we will be discussing three concepts. One is commencement. Commencement of capitalization. It means start of capitalization. Commencement of capitalization. Then we will be discussing suspension of capitalization. Suspension. Suspend karna. Suspension of capitalization means defer kar dena. Deferment of capitalization. Then we will be discussing cessation of capitalization. CESSATION. Cessation of capitalization. Cessation of capitalization means stopping of capitalization. See, period of capitalization, we will be discussing start of capitalization, which is commencement. Then we will discussing deferment of capitalization, which is suspension. Then we will discussing stopping of capitalization, stop the capitalization, which is cessation. Okay, ending of capitalization. So then there are some disclosures. So this is a very small standard, but very important standard. Generally, this standard may be asked in the examination between the questions, like there is a question on property, plant and equipment or intangible asset, and the concept of borrowing cost has been tested as a part of that particular question. Okay, so very small standard, but very important standard. Okay, so disclosure. So this is the entire structure of the standard. These two parts in between are very critical and very important to understand. So I'll discuss all the case studies of the study material. I'll discuss the concept one by one. Okay, but this is the entire structure where we will be discussing the main principle. We will be discussing scope. We will be discussing borrowing cost eligible for capitalization. There we will be discussing specific borrowing cost, general borrowing cost, capitalization rate, period of capitalization, commencement, suspension, cessation, and disclosure. And between this, there is a recognition also. Basically, borrowing cost eligible for capitalization and recognition. So recognition. Okay. So this is the entire structure. So let's move on to the concept. Let me remove this board. Coming to the main principle. So what is the main principle? The main principle is borrowing cost, which is directly related to borrowing costs that are directly related to acquisition, construction, and production of a qualifying asset will be capitalized as a part of that asset. So what is the objective of this standard? The objective of this standard is very clear. Borrowing cost directly related to borrowing cost directly related to ACP, ACP, Assistant Commissioner of Police. This is not Assistant Commissioner of Police. This is acquisition, construction, and production. Acquisition, construction, and production. Okay. You must have seen a. On this Sony TV, there is a program which is known as CID, ACP. Okay, ACP Pardyuman. So this is not ACP. This is acquisition, construction, and production. Okay, right, Costa? Right, Ambika? So borrowing cost directly related to acquisition, construction, and production of qualifying asset. QA. QA is Ambika, not question and answer. Chavi, it is not question and answer. It is qualifying asset. Borrowing cost directly related to acquisition, construction, and production of qualifying asset will be capitalized as a part of that asset. Will be capitalized as a part of that asset. Okay. Will be capitalized as a part of that asset. Capitalized as part of that asset. Okay. So borrowing cost, what we are talking here, we are talking about the objective of the standard. We are talking about the main principle, core principle of this particular standard. So borrowing cost directly related to acquisition, construction, and production of qualifying asset will be capitalized as a part of that asset. Will be capitalized as a part of that asset. Am I right? Any problem? Okay. Okay. So what is the standard which we are having in Indian GAAP? What is that standard? Accounting standard 16. AS 16 talks about borrowing cost. And what about internationally? If you have elected for GFRS paper, so what is the standard in IFRS? It is IAS 23. IAS 23, International Accounting Standard 23. Ind AS 23. AS 16. So technically there is no much differences between AS 16 and Ind AS 23. Okay. So this is the main principle. We understood that borrowing cost, which is directly related to acquisition, construction, or production of qualifying asset, will be capitalized as a part of that asset, and other borrowing cost will charge as an expense. Other will go to P&L as an expense. Okay. So it means two things are very important. First, there should be a borrowing cost, of course. This is the standard. Second, it should be directly related to acquisition, construction, or production of qualifying asset. Now, what is meant by qualifying asset? What is meant by qualifying asset? Qualifying asset. What is meant by qualifying asset? So I'll take an example and I'll ask you which one is qualifying asset and what is the difference between these two. So there is a company, let's say Ambika Limited. Ambika Limited is a company. So Ambika Limited wants two premises to operate. Okay. So Ambika Limited wants to have two offices. Okay. So one office is in, let's say, Lonavala, and the one office is in Bandra. Okay. So in Bandra, Ambika Limited has purchased an office. So this office has been purchased by Ambika Limited. Okay. This is an office which is purchased by Ambika Limited in Bandra. In Lonavala, the space was not available. Sorry, the ready to move in offices were not available, and hence Ambika Limited decided to construct a building. Okay. So in Lonavala, the building is getting constructed. Okay. Now my question is, which is a qualifying asset? Which is a qualifying asset? This Bandra office or this Lonavala office? The concept is both of them are asset. Am I right? Both of them are asset. This Bandra building which Ambika Limited has purchased is an asset. This Lonavala building which Ambika Limited is getting constructed is an asset. So which one is qualifying asset and what is meant by qualifying asset? We need to understand only two items in this particular standard. What is meant by borrowing cost And what is meant by qualifying asset? Pujita is saying, sir, it takes substantial period of time to get ready for intended use or sale. Okay. Anything else? So in this case, this Bandra building is ready to move in. It is ready to use when acquired. It is ready to use when acquired. Of course, some period of time may be there, like some temporary period of time. For example, Ambika Limited has purchased office in the month of September, and they want to start or they want to use the office from Diwali, okay, or they want to have a whitewash or some small modification in that particular office, okay. But largely, this office is ready for use when Ambika Limited is acquired. But in case of Lonavala building, it will take substantial period of time. It will take time to get ready for use, and hence this is known as a qualifying asset. This Lonavala office is a qualifying asset, and this is a complete asset. This is a complete asset. CA, not a chartered accountant. It's a complete asset. Okay, complete asset. So Lonavala building is a qualifying asset. So what is meant by qualifying asset? Technically, qualifying asset means WIP asset. Means WIP asset. Work in progress asset. Work in progress asset. Okay, means which takes a substantial period of time for getting ready for intended use or sale. Mind my words, my dear friends. Intended use or sale. Sir, why this word intended use or sale has been used? For example, there is a land. There is a land. Okay. So Pujita Limited has acquired a land. Now Pujita Limited has acquired a land, and the objective of that land is to divide into the land parcels and sell the land. Okay. So in this case, this land is not a qualifying asset. Why? Because the intention of the management is to resell that land. Now, second example, Kaustav Limited has acquired a land, and Kaustav Limited wants to do a construction on that particular land. They want to construct a bungalows. They want to construct a flats on that particular land. So Kaustav Limited is acquiring a land for the purpose of development. In this case, the intention of the management is to develop that land. So in this case, this land will become a qualifying asset. Am I right? Correct. Okay. So now Ambika is saying, sir, qualifying asset is an asset which takes substantial period of time, generally more than 12 months. So let me tell you, friends, there is a big difference between AS 16 and Ind AS 23 as far as definition of qualifying asset is concerned. Okay. So under accounting standard, substantial period of time was defined. It is more than 12 months. But under Ind AS and IFRS, substantial period of time is not defined. It is depending on the judgment of the management. So generally 6 months could be a substantial period of time, 9 months could be a substantial period of time. So management should specify the judgment that whether they are taking 6 months, 9 months, or more than 12 months as a substantial period of time. This will form part of the accounting policy by the management. Okay. So we discussed this part. Now we are moving on to the scope part. Okay. So coming to the scope part, this standard is applicable. The name is borrowing cost. So this standard is only applicable when the company has a borrowing. So let me share my presentation here. I hope my presentation is visible. I hope it is visible. So an entity shall apply this standard in accounting for borrowing cost. Of course, if there is a borrowing, then of course this standard will be applicable. Sir, whether this standard will be applicable on the notional cost of the borrowing, what is meant by notional cost of the borrowing, or imputed cost of the borrowing? For example, my own funds. I have used my own funds, my own capital for the purpose of construction of a qualifying asset, for the purpose of construction of an asset. Okay. So can I say, if I have not used my own funds in this particular project, then I will deposit the money into the bank or fixed deposit, and I will receive an interest of 6% per annum. So in this case, my cost of money or my cost of capital is, let's say, 6% or 7%. So can I capitalize such amount as a part of the cost of the project or cost of the asset? Answer is no. The standard says that there must be actual borrowing. There must be actual borrowing. So this standard is applicable on the borrowings. This standard is not applicable on the notional cost of the equity, notional cost of the capital, or imputed cost of the capital. Okay. It does not apply to actual or imputed cost of equity, included preferred capital not classified as a liability. For example, Reliance Power. Have you heard about Reliance Power? So in 2008, Reliance Power has the biggest IPO in 2008. Okay. Even recently, if you have seen Burger King, so Burger King has come up with an IPO roughly amounting to 850 or 900 crores. Okay. So Burger King says that this amount has been used for development of stores. Okay. Or Reliance Power has said that the money which they have raised by the issuance of equity, that will be used to construct power plants. Okay. Now the question is, when they have raised equity, so there is a cost to equity, like underwriter commission, like cost of issuance of equity, dividend on equity. So whether these kind of expenses will be capitalized as a borrowing cost? Answer is no, because this is not a borrowing, this is a capital. Okay, this is a capital. So standard says that this standard does not apply to actual or imputed cost of equity, included preference share capital not classified as liability. I believe you guys have a session on financial instruments, Ind AS 32, 109 and 107, and you are well versed with the preference share capital classified as equity or classified as liability. For example, there is a irredeemable preference share capital, the preference share capital which is not going to be redeemed. In that case, it is like a equity. And if the preference share capital is going to be redeemed after 5 years, it will be liability. Okay, so we understood that part very, very technically and very clearly. Okay, under Indian GAAP, all the preference share capital will be classified as a capital, but under Ind AS, if it is redeemable, it is a liability. If it is irredeemable, it is a equity kind of thing, other equity. Okay, so this standard does not apply to actual or imputed cost of equity. It is only applicable to the cost of the borrowings. This standard will not be applicable to borrowing costs related to which one? Biological asset. Biological asset which is measured at fair value less cost to sale. Okay, so let me tell you, this biological asset may be excluded from most of the standards. Why? Because this biological asset has its own standard, which is Ind AS 41, and it has its own or separate concept of recognition and measurement. Like biological assets are measured at fair value less cost to sell. You will have a session on Ind AS 41 also. Okay, understood? So this, if the company has taken a borrowing which is related to biological asset, so this borrowing cost standard is not applicable on that particular biological asset. Okay. Second piece, inventories that are manufactured or otherwise produced in a large quantity and on repetitive basis. Okay, large quantity and on a repetitive basis, even though it will take a substantial period of time. What does it mean? Second part, Ambika, can you please explain what is meant by the second part? First part we have understood, sir. This borrowing cost standard is not applicable on the biological asset which is covered under Ind AS 41. The second part, inventories which are manufactured or otherwise produced in large quantity and on repetitive basis. What is meant by this? What is meant by this? Kaustav, can you please explain? Prashant, Chavi, can you please explain? So basically, let me explain this concept with the help of an example. This is a Maruti Limited. This is Dilip Chhabadia, DC. Dilip Chhabadia Limited. Okay. So Maruti Limited. What is the business of Maruti? To manufacture or to produce Maruti cars. To produce cars. What is cars? What is cars for Maruti? Is it inventory? Answer is yes. Answer is yes. And what is cars for DC Limited? It is inventory. Answer is yes. Car is inventory. What is the difference between the business model of Maruti and DC Limited? So DC Limited convert the cars. Okay. DC Limited convert the normal cars into a modified cars or sports car. For example, WagonR. So Maruti Limited manufacture WagonR or Swift cars. Okay. And this DC Limited modify the WagonR or Swift car into a sports car, into a fabulous car. Okay. So they customize the cars, they modify the cars. Okay. So for both of them, it is an inventory. Okay. But Maruti Limited produce the car in large quantity, and on repetitive basis. Am I right? Am I right? So Maruti Limited produce the cars in large quantity and on repetitive basis. But Dilip Chhabadia, so Maruti Limited produce this car in large quantity and on repetitive basis. Although this car will take a substantial period of time for getting manufactured, okay, for getting ready for intended sale. So the word is not only intended use, the word is intended sell also. Okay. But if I talk about Dilip Chhabadia, so they manufacture or they modify the car as per the specific requirement. Okay. So again, Dilip Chhabadia modify the car, manufacture the car. Okay. But it is not on a repetitive basis. It is not on a repetitive basis, or it is not in a large quantity. This Maruti is manufacturing car on a repetitive basis and in large quantities. Okay. And this will take a substantial period of time. Dilip Chhabadia is not manufacturing the cars or the inventory in a large quantity and on repetitive basis. Okay. So generally they modify, they manufacture the car on a order basis, Okay. So in this case, this is known as a made to order inventory. Okay. So on this cars, if Maruti has taken a loan for the manufacturing of inventory, working capital loan, CC limit loan for manufacturing of inventory, this interest on loan will not be capitalized. This will go to P&L. Yes. But if I talk about DC Limited, which is manufacturing in small quantity on the basis of order received. Okay. So if DC Limited has taken a loan for manufacturing such car or modifying such car, in that case, that interest will be capitalized. Second example, for inventories which are manufactured in large quantity on repetitive basis and which take a substantial period of time, whiskey, wine. In case of liquor industries, of course, if I talk about Kingfisher, okay, if I talk about these kind of liquor industry, Bira, so they of course manufacture these liquors in large quantity on a repetitive basis. It is their business model. Okay. And this will take a substantial period of time for getting ready for sale. Okay. Ready for intended sale. And hence this will not be covered under Ind AS 23. And the interest, if any, like working capital loan, CC limit loan, will not be capitalized. Is it okay? Yes, Ambika, you are right. It means borrowing cost on inventory is debited to P&L. Yes, Ambika, you are right. But you need to see, I have also told that this DC Limited inventory, borrowing cost on DC Limited inventory is getting capitalized, but borrowing cost on Maruti Limited inventory is not getting capitalized. So you need to see which is covered under Ind AS 23. So if it is made to order inventories, like, have you heard about Boeing? BOEING. So company which is in the manufacturer of aircrafts. Okay. The company which is into the manufacturing of aircrafts. Okay. Like you have also heard about that the company has ordered some fighter planes. India has ordered some fighter planes from a Russian company. Okay, so that company is manufacturing the fighter planes, or the company is manufacturing the aircraft on the order basis. They are not manufacturing aircraft on a repetitive basis. Okay, in large quantity. So it could be on a repetitive basis, but it should not be a large quantity, because huge amount of money has been involved in the manufacturing of aircraft. So they manufacture aircraft on the order basis. Once they get the order, they will deliver the aircraft in 6 months or 12 months. Okay, they will deliver the fighter planes in 12 months or 6 months. So in these cases, they manufacture these kind of inventory in small quantities. Okay, so on the basis of orders. So if the company has taken a loan for manufacturing of such inventory, the interest on that loan should be capitalized as part of the cost of the inventory. Okay, any doubt, any problem so far? Can we move on? Okay, so we have covered this. Now we need to understand two items: borrowing cost and qualifying asset. First of all, we will understand qualifying asset, because qualifying asset we have already discussed. Qualifying asset is an asset which takes a substantial period of time for getting ready for its intended use or sale. The word is intended use or sale. Okay, why intended sale? Because it could be a inventory for that particular company, like Boeing. Okay, like Dilip Chhabadiya. Okay, so like if I talk about let's say these Otis elevators. Okay, which is into manufacturing of lifts. Okay, like cranes. Okay, so friends, qualifying asset is an asset. It's a work in progress situation of asset which takes a substantial period of time for getting ready for intended use or sale. And what could be a qualifying asset? Property, plant and equipment could be a qualifying asset. Intangible asset could be a qualifying asset. For example, SAP. Okay, so if the company is implementing SAP, probably it could take years, 1 year, 2 year, 3 years. And if the company has taken a loan for implementation of SAP, it has to be capitalized. The interest has to be capitalized as a part of the cost of the SAP. Okay, so PPE could be a qualifying asset. Intangible asset could be a qualifying asset. Investment property could be a qualifying asset. Made to order inventories, the inventories which take a substantial period of time, and it is manufactured on the basis of the order received. Okay, sir, if there is a garments company which manufacture the article on the order basis, whether the interest on loan on such inventory will be capitalized? Answer is no, because that garment company is manufacturing the order in the large quantity and on repetitive basis, and the most important part is it will not take substantial period of time for getting ready for use. Okay, understood? Have you understood? So this is the qualifying asset. Now what is borrowing cost? Borrowing cost. So what is borrowing cost? Any cost which is incurred on borrowing, as simple as that. Any cost which is incurred on the borrowing. Borrowing cost are interest and other cost for borrowing of funds. If you will borrow, what could be the cost of borrowing? Ambika, can you tell me, if you will go to a bank and you will ask for a borrowing, what is the amount which bank can charge for such borrowing? What is the amount or what are the costs which bank may ask for such kind of borrowings? So what is the amount or what could be the cost which bank may ask for such borrowings? Okay. Borrowing cost. What could be the borrowing cost? Interest and other related cost. Interest cost. What could be other cost? Processing fee. Processing fee. And ancillary costs. Bank may ask for processing fee also. So interest cost, processing fee, and ancillary cost. Okay. Okay. And these are calculated on EIR basis. These are calculated on effective interest rate basis. Under Indian GAAP, there was a concept of time proportionate basis, but here it is a concept of effective interest rate basis. So in Ind AS 109, you have already read the concept of amortized cost. You have already read the concept of effective interest rate. Okay. Now, what is meant by effective interest rate? What is meant by effective interest rate? So this borrowing cost needs to be capitalized as a part of the effective interest rate. So let me give you an example. For example, the company has taken a loan of rupees 100. Loan of 100 rupees. Okay. And there is a interest rate. There is an interest of, let's say interest rate is 10%. Interest rate is 10%. Okay. And the bank had charged a processing fee. Bank had charged a processing fee of 5%. The bank had charged a processing fee of 5%. There is an interest rate of 10%, and loan amount is 100 rupees, and it is repayable after 1 year. It is repayable after 1 year. Repayable in 1 year. Now, friends, what is the amount of processing fee? What is the amount of processing fee in this question? What is the amount of processing fee? Yes, Preeti, you are right. If the inventory has been manufactured in large quantity and on repetitive basis, and the most important part, it will not take substantial period of time for getting ready for intended use or sale. It will charge to P&L. Okay. So my question is, I am discussing borrowing cost, and the first part is interest cost and processing fee, or interest cost and other related cost. So loan amount is 100 rupees, processing fee is 5%, interest rate is 10%. So what is the amount of interest the company will pay in 1 year according to Indian GAAP? What is the amount of interest? What is the amount of interest the company will pay in 1 year? The amount of interest is 10 rupees. Yes, Ambika. 5 rupees processing fee. Okay. In Indian GAAP, this 5 rupee processing fee we used to debit into the P&L. And we say the interest amount is 10 rupees. Am I right? But what is the effective interest rate? So interest rate is 10%. Interest rate is 10%. But what is effective interest rate? Can any of you tell me what is the effective interest rate here? Because you all have had many sessions on Ind AS on financial instruments. See, we need to see what is the difference between inflow and outflow. For calculation of effective interest rate, we need to see what is the rate which equalizes the inflow and outflow. Okay. First of all, what is the inflow? What is the amount the company has received? What is the amount the company has received on account of this loan? Costa, what amount the company has received on account of this loan? The company has received 100 minus 5. Inflow is 100 minus 5. 95. Am I right? The company got a loan of 100 and repay 5 rupees as a processing fee. So bank has sanctioned 100 rupees. There is a loan of 100 rupees, but bank has only paid 95 rupees to the company. Okay. So 95 rupees inflow. Now, Ambika, what is the outflow? After 1 year, how much principal the company will pay to the bank? What is the amount of principal the company will pay to the bank? Kaustav is saying inflow is 95. Ambika is saying, Ambika, inflow is not 100. Inflow is 95. 100 is the loan amount. 5 rupee processing fee has been deducted at the time of granting of loan. Okay. So inflow is 95. What is outflow? The principal payment is 100 and the interest payment is, the principal payment is 100 and the interest payment is 10. So what is the total payment? 110. The total payment is 110. Okay. So what is the difference between 95 and 110? What is the difference between 95 and 110? The difference is 15 rupees. The difference is 15 rupees. Okay. So now what is the effective interest rate? This 15 rupees has been paid or is payable on 95 rupees. So what is the interest rate? 15 divided by 95. So what is the interest rate cost of 15 divided by 95? So let me find my calculator. So it is 15 divided by 95 is equal to 15.79%. 15.79%. Okay. 15.79% is the effective interest rate. So according to Ind AS 109, initially this loan is required to be shown in the books of accounts at 95 and 15.79% of 95 will be charged as an expense. Entry is interest expense account debit to loan account. Okay. So 95 multiplied by 15.79% will come out as a 15. The closing balance is 110 and this will be paid. Okay. So if the borrowing has been taken for the construction of a qualifying asset, then the borrowing cost, I mean to say interest and other costs, should be capitalized on the basis of effective interest rate. So in this case, this 15 rupees is required to be capitalized, but on the effective interest rate, but on the EIR basis. Okay. Is it clear? So the only thing is this interest cost and processing fee is required to be capitalized, ancillary cost is required to be capitalized. So basically it is on the basis of effective interest rate. And what is effective interest rate? It includes all the costs. Okay. So it talks about the bridge between the inflow and outflow. So we understood this part, sir. Now what is the second part? So we discussed first part, interest on the basis of EIR. Interest on the basis of effective interest rate. So first part, interest at the rate of effective interest rate. Second, for example, the company is constructing a building. Okay, the company is constructing a factory or a building, let's say. So for construction of a factory or a building, there are some construction equipments like crane. Okay, like some mixing machine which mixes the material. Okay, so the company has hired a crane on a lease basis. The company has hired a crane on a lease basis because the construction will over in the next 2 or 3 years, and after that this crane will of no use to the company. So instead of purchasing a crane, the company has taken a crane on a lease basis. Okay. So you will read Ind AS 116. You must have some idea about Ind AS 116, that there is a new standard Ind AS 116. Okay. And this Ind AS 116 talks about recognition of operating leases into a right of use asset and leasehold obligation. So in this new standard of Ind AS 116, the accounting, the lessee accounting has completely been changed. There is no difference between operating lease and finance lease as far as Ind AS 116 is concerned. What does it mean? It means when the lessee take an asset on a lease basis, the lessee is required to capitalize the asset and is required to recognize the liability as a leasehold obligation. So the standard says that if a company has taken any asset on lease basis, so interest on leasehold obligation, interest on leasehold obligation will also capitalized. Interest on leasehold obligation as per Ind AS 116, as per Ind AS 116 is also going to be capitalized. Okay. So अगर कंपनी ने कोई एसेट लीज पे ली है कंस्ट्रक्शन करने के लिए तो उसकी अकाउंटिंग क्या होगी? अकाउंटिंग शुड बी एज पर इंड AS 116. क्या अकाउंटिंग होगी? कंपनी एक राइट ऑफ यूज एसेट क्रिएट करेगी और लीज होल्ड ऑब्लिगेशन क्रिएट करेगी. And on leasehold obligation, the company will pay interest. Okay, so that interest will be capitalized as a part of the borrowing cost. Is it clear? Is it clear or not clear? Is this clear or not clear? Tell me. So the first one is borrowing cost or interest and other costs for borrowing of funds. It may include interest expense calculated using the effective interest rate method under Ind AS 109. Interest on leasehold obligation as per Ind AS 116 leases. Okay. So is it clear so far? Guys, I would appreciate your reward. Okay, clear. Great. The third one is very important. The third one is very important, and sometimes question may be asked from this particular concept. Exchange difference arising from foreign currency borrowing to the extent they are regarded as an adjustment to interest cost. What does it mean? Standard says that the third point, exchange difference arising from foreign currency borrowings to the extent that they are regarded as an adjustment to interest cost. So it is talking about if the company has taken a foreign currency borrowing for the purpose of construction of a qualifying asset. If the company has taken a foreign currency borrowing, and in case of foreign currency, there will be a volatility in the exchange rate, there may be an exchange difference, there may be a exchange gain or loss. Okay, so standard says that exchange difference is also required to be capitalized, but to the extent it will be regarded as an interest cost. Okay, sir, we are not clear on this, don't worry. So let me take you through with illustration number 1 of Institute study material, then it will be clear. Illustration number 1. Okay, illustration number 1, page number 7.193. Okay, of the study material which is reprinted on February 2020. ABC Limited has taken a loan of USD 20,000 on 1st April 2001 for constructing a plant at an interest rate of 5% per annum payable on annual basis. On 1st April 2001, the exchange rate between the currencies, that is USD versus INR, was 45 per USD. The exchange rate on the reporting date, that is 31st March 2002, is rupees 48 per USD. The corresponding amount could have been borrowed by ABC from State Bank of India in local currency at an interest rate of 11% per annum on 1st April 2001. Compute the borrowing cost to be capitalized for the construction of plant by ABC Limited. Okay. So basically, if we see this question talks about there is a company ABC Limited which has taken a loan of 20,000 US dollars. So this loan is into foreign currency. And this loan was acquired on 1st April 2001 for the purpose of construction of a qualifying asset. And why the company goes to a foreign currency borrowings? Because the foreign currency borrowings are generally cheaper. When you take a borrowing from US market, when you take a borrowing from European market or Middle East market, the borrowing rates are much cheaper rather than the Indian rates. But what is the risk? So sir, you have told about the gain, that the borrowing rates are cheaper, but there is a risk also. What is the risk? The risk is like you have seen that in the international market. So if you see the rupee is getting weaker and the dollar is getting expensive or costlier. Okay. So if we have taken a foreign currency borrowing, so of course there is a gain in terms of interest rate, but there is a risk of getting a rupee weaker and getting a dollar stronger. So if the dollar will get more stronger, in that case we have to pay more money in terms of repayment of loan. Okay. So on 1st April 2001, the exchange rate is also given, which is 45 rupees. And the exchange rate after 1 year, that is on reporting date, is also given, which is 48 rupees. If you see, this 45 become 48. So there is a loss to the company. And it says that if the company will not go for foreign currency borrowing, but the company has borrowed from the Indian market, let's say from State Bank of India, so the interest rate was not 5%, it was 11%. Okay. So see, in US market it is 5%, in Indian market it is 11%. But in Indian market there is no risk of exchange loss. But in US market, since we are getting this borrowing in foreign currency, there is a risk of exchange loss. There could be a gain also, but of course there is a risk of exchange loss. So standard says that compute the borrowing cost to be capitalized for construction of plant by this particular company. So sir, we are very clear about the interest cost. Interest cost needs to be capitalized, as simple as that. Okay. But what is the third point? You have told us the third point, that if there is an exchange difference, and this exchange difference to the extent of adjustment to interest cost is also going to be capitalized. Now we need to understand that this exchange difference, how to calculate this exchange difference to the extent it is considered as an adjustment to interest cost. So we need to understand this. Okay. So let me solve this in illustration number 1. And after that, you will be expert in this particular borrowing cost calculations. Illustration number 1, page number 7.193 of module 2 of Institute Study Material. So first of all, we need to understand the interest on foreign currency. Interest on foreign currency loan. Okay. So first of all, what is the amount of foreign currency loan? What is the amount of foreign currency loan? It is 20,000 US dollar. It is 20,000 US dollar. What is the interest rate? Interest rate is 5%. So what is the amount of interest? Amount of interest is 1,000 US dollar. Am I right? 1,000 US dollar. Now this is payable on annual basis. So on 31st March 2002, what is the value of interest in INR? So what is the value in INR? In INR, what is the value in INR? 1,000 multiplied by 48. So if you see, on 31st March 2002, the exchange rate is given as 48 rupees per USD. So 48 multiplied by 1,000 is equal to 48,000. 48. So the value of interest in terms of Indian rupee is 48,000. Okay. Now the question says that so this is the value of interest. Now exchange loss, but since dollar is getting stronger, so there is an exchange loss on foreign currency loan. So what is the exchange loss? $20,000 loan is there, $20,000 multiply by, when we have acquired this loan, the rate was 45, but now the rate is 48. So we had a loss to the extent of 60,000 INR, 60,000 rupees. 60,000 rupees. See, the interest rate is cheaper. It is 5% only, but there is a loss of 60,000 rupees also due to the dollar getting stronger. Okay. Any problem so far? Any problem? Please confirm urgently. Please confirm quickly. So far we have only calculated interest on foreign currency loan. Then we have converted foreign currency into Indian currency, and we have also calculated the exchange loss on foreign currency loan. So we have done only these two things. Okay. Now we need to calculate. We need to calculate the interest in Indian currency, interest in Indian rupee, Indian currency, if the loan is taken in INR, if the loan is taken in Indian rupees, loan is taken in India. So tell me, what is the loan amount? So what could be the loan amount in Indian rupees? So what could be the loan amount from SBI? On 1st April 2001, $20,000 loan has been taken. At that time, the value of USD versus INR was 45. So what could be the value of loan which should be taken from State Bank of India? It is 9 lakh. It is 9 lakh. Okay. So if instead of going to the US market, if we had taken a loan from Indian market, State Bank of India, we need to take a loan of 9 lakh rupees. Okay. We need to take a loan of 9 lakh rupees. And what is the interest rate? But we need to pay a higher interest rate. So interest rate was 11%. So what is the interest amount? Costa, what is the interest amount in Indian rupee? What is the interest amount? The interest amount is 9 lakh multiplied by 11%, which is 99,000. Which is 99,000. So tell me, if we compute this foreign currency interest in INR, it is 48,000 rupees. If we take a Indian rupee loan, then the interest amount is 99,000 rupees. So how much savings are there? How much savings are there in terms of interest? Third. How much savings are there in terms of interest? Savings in interest between INR and a foreign currency loan. So what is the saving in interest? What is the savings in interest? So savings in interest is 99,000 minus 48,000. So how much savings are there? 51,000. There is a saving of 51,000. Okay. There is a savings of 51,000. So the standard says that any exchange loss to the extent of savings, will be capitalized as a part of the borrowing cost. So it means, now what is the exchange difference? What is the exchange loss? What is the exchange loss, Ambika? The exchange loss is 60,000. So out of 60,000, 51,000 is going to be capitalized as an exchange difference, which is regarded as an adjustment to interest cost. 51,000 is required to be capitalized as a borrowing cost, and 9,000 will go to P&L as per Ind AS 21. 9,000 will go to P&L. So in nutshell, what is the amount of borrowing cost in case of foreign currency borrowing? The amount of borrowing cost includes two parts. One is interest cost. The second one is exchange difference or exchange loss. Okay. And it should not be greater than the borrowings if has been done in Indian rupee. What should be the interest cost? So technically speaking, the amount which has to be capitalized is 99,000 rupees as a borrowing cost. So let me summarize this. In this case, borrowing cost to be capitalized is how much? One is interest cost, 48,000. Exchange loss is equal to 51,000. The total is 99,000. Okay. So this is going to be capitalized. And 9,000. So this is capitalized and this is P&L. So in P&L 9,000 exchange loss will go. Okay. So Costa, very good question. And I have already given the answer of this particular question. You are asking, Costa is asking, sir, what is the logic behind capitalization of exchange loss to the extent of difference in interest? So Costa, the logic is why the company are going into the foreign market for the borrowings. There is one reason, the interest rate is cheaper. Like in this case, we have seen in Indian market, the interest rate is 11%. In the foreign market, the interest rate is 5%. If you go to Europe, in Europe, the inflation rate is hardly 1% or 1.5%. But in India, the inflation rate is in the tune of 7 to 9% or 7 to 8%. Okay. So here the interest rate is 8%, 9%, 11%, 12%. But in Europe, it is 1%, 2%, 3%. So that is why the company go for the international market for taking up borrowings. But there is a gain, but there is an inherent risk also. What is the inherent risk? The inherent risk is the fluctuation of the currency prices, the fluctuation of the exchange rates. Okay. So if there is a gain, the company is capitalizing a lesser amount. I mean to say, if there is a gain in terms of cheaper interest rate, the company is capitalizing a lesser amount. But the company should not ignore the inherent risk behind this, cheaper rate of interest. So that is why the standard says that had the company take the borrowings from the Indian market, I mean to say from the geography where they are operating, so that amount should be logical, that market value of the loan, that market value of the interest, logical should be the interest cost which is going to be capitalized. Otherwise the comparable will not be the comparable between the two companies. Let's say Ambika Limited is taking a loan from India and Kostab Limited is taking a loan from the Europe. Of course, the two asset which has been constructed in Indian economy or Indian geography has a similar prices, but in terms of borrowing cost, the cost will be different. Okay, so that is why this was the logic behind the exchange difference to be capitalized to the extent of adjustment to interest cost. Okay. So Ambika is asking, sir, is 9,000 is in respect of principal amount. So Ambika, 9,000 is 51 plus 9. Total exchange loss is 60,000. Okay. The total interest loan, the total interest expense is 60,000. In exchange difference is 60,000. So 60 to the extent of 51, because 99 minus 48 is 51. So to the extent of 51,000 we have capitalized. The remaining 9,000 will go to P&L. Now there must be a question in your mind, sir, what will happen if in the next year this 48 rupees become 46 rupees? In that case, there will be a gain of 2 rupees, 20,000 multiplied by 2, 40,000. Sir, what will happen then? In that case, the amount which have been capitalized, so this is 51,000 which have been capitalized, and if the rate will go down, in that case, this amount is required to be reversed. Okay. For example, in the next year, this 48 again become 45. So there is an unrealized gain of 20,000 multiplied by 3, 60,000. So in that case, to the extent exchange loss has been capitalized, that is required to be reversed. And the remaining will go to P&L. Okay. Yes, Kaustav, you're right. It means capitalization has to be made if it has been made locally. Okay. But let me tell you, you have to remember one thing. Sir, what will happen if the rate becomes cheaper? I mean to say, if the exchange gain is there. For example, in the first year, sir, the 48,000 is the interest amount. Okay. And locally it is 99,000. And there is an unrealized gain also. Okay. For example, this 45 becomes 44. So there is a gain of 20,000. So in this case, this 48,000 is only going to be capitalized. That gain will go to P&L. That gain will go to P&L because that is a abnormal kind of gain. Okay. So it does not mean if we need to capitalize 99,000 always. It does not mean. But in case of loss, the capitalization should not exceed 99,000. Is it clear? Kaustav, Ambika, Chavi, Pujita, Nanda, is it clear or not clear? This is a very important concept. Just you have to remember two things in mind. First, interest cost is always going to be capitalized. Second, you need to see, is it exchange gain or is it a exchange loss? If the first time it is exchange gain, you have to take it to the P&L. If the first time it is exchange loss, you need to see what is that total amount if I source this borrowing locally. Okay. For example, in this case, 99,000 is the total interest amount. Okay. So the difference between interest in Indian rupee and the difference between interest in foreign currency. So to that extent, we can capitalize the exchange difference. Okay. If subsequently the rate will go down, exchange difference will go down. I mean to say there will be exchange gain. In that case, we need to reverse whatever we have capitalized. We need to reverse to that extent. Okay. Kaustav is saying crystal clear, sir. Thank you, Kaustav. So what about others? Nanda, Ambika, Chavi, Prashant, Shreyansh. What about others? Okay. So let me take you with the next concept. So this was the concept which we have discussed. So these were the two important terminologies. First one is borrowing cost and the second one is qualifying asset, which we have discussed in detail. The borrowing cost is interest cost as per EIR, interest on lease obligation as per Ind AS 116, and exchange difference arising from foreign currency borrowings to the extent it is regarded as an adjustment to interest cost. Okay. So Preeti, generally you need to see the MCLR, marginal cost of lending rate. So generally you need to see the RBI rate or SBI rate, okay, for doing the comparison. Recognition. Now we have discussed that borrowing cost, which is directly attributable to the ACP, acquisition, construction, or production of a qualifying asset, is form part of the cost of that asset. Okay. And what is the recognition criteria? Two criteria: future economic benefit should be probable and cost can be measured reliably. Okay. And what is directly attributable means the borrowing cost that would have been avoided if the expenditure on the qualifying asset had not been made. What does it mean? First of all, borrowing cost which is directly related or directly attributable to ACP of the qualifying asset. What is directly attributable means if the company has not constructed this qualifying asset, the borrowing should not be required. The borrowing should have been avoided. So this is the meaning of directly attributable. And what is the meaning of two conditions? If two conditions will be satisfied, then borrowing cost will be capitalized as a cost of asset. One is future economic benefit should be probable and cost can be measured reliably. For example, the company was constructing a factory. Okay. The company was constructing a factory or the company was constructing a machinery. The government has banned the output which came from that particular machinery. It means the future economic benefit from that machinery will not be there. So if the future economic benefit from that qualifying asset will not be there, so such borrowing cost will not be required to be capitalized. Okay. So these are the two conditions which we have also read in terms of Ind AS 16 and Ind AS 16 and Ind AS 38. So just give me a minute, students. Okay. Now measurements of borrowing. So let me take you with the next part. Now we are discussing the borrowing eligible for capitalization or measurement of borrowing cost. Measurement of borrowing cost. Measurement of borrowing cost. So borrowings are of two types. Borrowings are of two types. One is specific borrowing, and the second one is general borrowing. General borrowing. What is meant by specific borrowing and what is meant by general borrowings? Specific borrowing, as I told you, for example, you or your parents must have taken a home loan at some point of time. So home loan means the underlying asset, the loan which has been taken is for the underlying asset, is for the related asset. Okay. So it means the borrowing has been done specifically for a particular asset, specifically for a particular asset. Okay. So this is a case of specific borrowing. This is a case of specific borrowing. Okay. Means the borrowing has been done specifically for a particular asset. So the life is very simple in case of a specific borrowing. So what is the borrowing cost which is going to be capitalized in case of a specific borrowing? In case of a specific borrowing, the borrowing cost which is going to be capitalized is equal to actual cost incurred minus actual cost incurred minus investment minus temporary income from investment. What is meant by minus temporary income from investment? For example, the company has taken a loan of rupees 1 crore for construction of factory on 1st April 2001. The company has taken a loan of rupees 1 crore for construction of factory on 1st April 2001. Okay. The factory has been completed on 31st March 2003. So it took 2 years for the completion of factory. So it is a qualifying asset. The interest cost is going to be capitalized. Since the company has taken a loan on the first day, so can you say that the entire 1 crore is required to be expensed off, or entire 1 crore outflow is required to be made on the first day? The answer is no. So the amount has to be outflown, or the amount has to be expensed off gradually. Okay. So what the company has done in the first year, that is in 2001-2002, and assuming the interest rate is 10%. So what is the interest amount? First of all, what is the interest amount? 1 crore multiplied by 10% is equal to 10 lakh. 10 lakh is the interest amount. And so during the year, the company has surplus funds, because let's say on the first day, in the initial 3 months, the company has expensed 10 lakh rupees. So the company has made a fixed deposit with the surplus funds arising out of this loan. And out of the small fixed deposits, the company has earned an interest of, let's say, 3 lakhs. So interest income on temporary investment of the surplus funds arising out of loan. So interest income is, let's say, 3 lakhs. So standard says that you need to reduce the temporary income from such investment of funds from the interest cost. So in this case, in the first year, 7 lakh is required to be capitalized as a part of the cost of the asset. Is it clear? Is it clear? Yes or no? Yes, no, or not applicable? Okay. So to understand the specific borrowing, let me take you through with one of the practical case study from the Institute study material. So when funds are borrowed specifically, actual cost incurred less any income earned on the temporary investment of such borrowings. Okay. Illustration number 2, page number, illustration number 2, page number 7.196. Alpha Limited on 1st April 2001 borrowed 9% 30 lakh to, so there is a loan of 30 lakh rupees, okay, to finance the construction of two qualifying assets, to finance the construction of two qualifying assets. Construction started on 1st April 2001. The loan facility was availed on 1st April 2001 and was utilized as follows, with remaining funds invested temporarily at 7%. So it says that the company has borrowed 30 lakh rupees, 9% is the cost of the loan, and two qualifying assets are there. Construction started on 1st April 2001 and the loan facility was also availed on 1st April 2001 and it was utilized as follows, with remaining fund invested temporarily at 7%. So on 1st April 2001, the company has utilized 5 lakh rupees for the factory building and 10 lakh rupees for the office building. And after 6 months, the company has utilized another 5 lakh rupees, that is on 1st October, for factory building, and 10 lakh rupees is for the office building. So total cost of factory building is 10 lakh and total cost of office building is 20 lakh. So as far as this loan is concerned, you are required to calculate the cost of the asset and the borrowing cost to be capitalized. So it is asking what should be the cost of the asset, means the asset cost plus interest cost which is going to be capitalized. Okay. Second, it is asking the borrowing cost. So you need to calculate the borrowing cost first, then you need to capitalize it with the cost of the asset. Okay. Perfect, guys. So first of all, what is the total borrowing? Total borrowing is 30 lakhs. The total borrowing is 30 lakhs. Okay. Illustration number 2, page number 7.196 of ICAI study material, reprinted edition February 2020. So first of all, we need to understand that what is the total loan amount? The total loan amount is, in case of a factory building, and the second one is office building. The total loan amount is 30 lakh rupees. So in this case, on 1st April 2001, how much amount has been taken? 30 lakh has been taken. On 1st April 2001, sorry. On 1st April 2001, the total loan is 30 lakh. Okay. And out of this 30 lakh, on 1st April 2001, 5 lakh has been utilized here and 10 lakh has been utilized here. So what is the remaining amount left with the company? What is the remaining amount left with the company? The remaining amount left with the company is 15 lakh. It is 15 lakh. Am I right? And on 1st October 2001, this 15 lakh has been used. So now the balance has been finished. 10 lakh, 20 lakh. Okay, 10 lakh, 20 lakh. So it means this 15 lakh has been invested, because in the question it is written that the surplus fund has been invested at the rate of 7%. What is the rate of interest? For this loan, it is 9%, and this amount has been invested for 6 months for 7%. For 7%. Okay. It is 7%. So now we need to calculate the borrowing cost. So let's calculate the borrowing cost first. Borrowing cost. First of all, what is the borrowing cost? What is the cost incurred here? 10 lakh rupees. So 10 lakh multiplied by 9%. Here 20 lakh multiply by 9%. So what is the total here? 90,000. It is 90,000 and it is 1,80,000. 90,000 and it is 1,80,000. Okay. 90 and 180. Now in this case, there is an investment income also. There is an investment income also, less investment income, which was for 6 months. So in this case, in case of factory building, it is 5 lakh, because out of 15 lakh, 5 lakh is in case of factory building and 10 lakh is in case of office building. So minus 5 lakh multiply by 7% is equal to how much? 30 into 6 by 12. It is for the 6 months. So 5 multiplied by 7%, 35,000. So it is 17,500. 17,500. Okay. Less. Here it is 10 lakh multiply by 7%, multiply by 6 by 12. How much is the amount? The amount is 35,000. So what is the borrowing cost to be capitalized? 90 minus 17,500. 90 minus 17,500 is how much amount? 90 minus 10, 80 and 72,500. And here it is 180 minus 35, 145. 1,45,000. Okay. So this is the borrowing cost. Now what is the cost of the asset? Now what is cost of asset? Cost of asset is 10 lakh A plus B. A plus B, which is 10 lakh 72,500. 10 lakh 72,500 in case of factory building and 21 lakh 45,000 in case of office building. So this is the question in case of specific borrowing. Is it clear? Is it clear to all of you? Any problem, any doubt, any query? Is it clear? Friends, is it okay for you? So Nanda, Costa, Ambika, Pujita, Prashant, Shreyansh, Chavi. Is it clear to all of you? Yes. Okay, good. So now students, so we have a next concept of general borrowing. So before starting a general borrowing, because we don't have much concept left for this particular standard. So let's have a break for 10 minutes. It's 8:23 now. So we'll start at 8:33. So let's have a break for 10 minutes. It's 8:23 now. So we'll start at 8:33. Yeah. So welcome again, students. After specific borrowing, let's understand the concept of general borrowings. So what is meant by general borrowings? Let me tell you, if you see the bigger companies or big companies, let's say Reliance, Airtel, Tata, so you must have seen that there is a treasury department in the company. And normally these companies require funds for the expansion, for the funds for the working capital. So these companies used to source the funds which they can source from the cheaper resources. Okay. For example, general borrowings. So specific borrowing was very simple, where we were aware that the loan has been taken for which qualifying asset, or loan has been taken for which particular asset or which asset. Okay. So we know that this is the asset and this loan has been taken on this particular asset and we need to capitalize this interest cost on this particular asset. But in case of general borrowing, since the borrowing has been made out of general pool and hence it was not known that this borrowing, which borrowing has been used for which particular asset. So let me brief you. For example, there is a treasury department in ABC Limited, and this treasury department has taken a loan of, let's say, 5% from Bank of India. Okay, and the loan amount is let's say 20 lakhs. This company has taken 7%, raised 7% funding from debenture. Okay, which is, let's say, 10 lakh. This company has taken 7% debentures worth rupees 10 lakh. This company has also raised, let's say, 8% funds from working capital loan, let's say, from State Bank of India. Okay, and this is, let's say, again 10 lakh. And this company has also taken a term loan worth rupees 9% from 9% term loan from, let's say, Lakshmi Vilas Bank, LVB, Lakshmi Vilas Bank, which is again worth rupees 10 lakh. So what is the total portfolio? So the company has sourced this borrowings from the four sources, 1, 2, 3, 4, and the total borrowing is 50 lakhs. Okay, and the respective interest cost is 20 multiplied by 5% is 1 lakh, and 10 multiplied by 7%, 10 lakh multiplied by 7% is 70,000, 0.7 lakhs. Again, it is 0.8 lakhs. Again, it is 0.9 lakhs. Okay, the total is 1.7 plus 0.8, 2.5 plus 0.9, 3.4 lakhs. The total interest cost is 3.4 lakhs. Okay. So friends, the Treasury Department of ABC Limited has sourced these four borrowings from this four particular banks or four particular resources, okay, at different rates. So they have 50 lakh rupees. Now, during the year, the company has intended to start a construction of a factory. The management has decided to construct a new factory, okay, and that new factory. So this is a general pool. So they have taken a borrowing and they have created a pool of funds, and the new factory construction cost will be, let's say, 25 lakhs. So the Treasury Department has given 25 lakhs to the project team for the construction of a factory out of this 50 lakhs. Now, Kaustav, can you tell me that this 25 lakh rupees is out of which borrowing? Can you tell me out of which borrowing or out of which combination of borrowing? Ambika, can you tell me? Is it easy? Is it easy to bifurcate that this 25 lakh has been from Bank of India and partly from debenture, or let's say it is from term loan, working capital, or let's say debenture? So what is the combination of borrowing and which borrowing has been used for the construction of this new factory? Can anyone Can anyone give some light on this? Answer is no, because the borrowing has been made as a general pool. So the borrowings have been made and created as a general pool. Okay. And now the funds from the general pool has been used for the construction of a qualifying asset. So in this case, standard says that you have to apply two steps. You have to apply two steps because it is not easy to separate. So you have to apply two steps. Step number one is, so I'll write here. Step 1, calculate weighted average cost of borrowing. Calculate WACB. Calculate weighted average cost of borrowing. Calculate WACB. Second, apply. Okay. WACB. Apply WACB for the period of use. Apply WACB for the period of use. Okay, till the completion of asset. So first, calculate weighted average cost of borrowing. So how this weighted average cost of borrowing will be calculated? So weighted average cost of borrowing is equal to let's say a total interest divided by total borrowing. So what is the weighted average cost of borrowing in this case? This is 3.4 lakh divided by 50 lakh. 3.4 divided by 50. So what is the answer? 3.4 divided by 50. It is 6.8%. 6.8%. So what is the weighted average cost of capital? It is 6.8%. Okay. And for example, this 25 lakh rupees, this loan is outstanding. This loan is outstanding in the next 2-3 years. Okay. This loan is outstanding till the time this asset has been constructed. Okay. So for example, this 25 lakh rupees, which has been used from this borrowing. So 6.8% will be applied on 25 lakh rupees and it will give you a interest cost. Okay. And that interest cost is going to be capitalized. Okay. So this was the concept. Now we will solve a case study from the Institute study material to discuss this concept more in detail. But can you understand this borrowing out of general pool as a concept, as a fundamental? Have you understood the concept of general borrowing as a fundamental? Have you understood? Okay. So let's move on to the presentation and then we will have a discussion in terms of a case study. So if funds are part of a general pool, apply a capitalization rate to the expenditure on that particular asset. What is the capitalization rate? It's a weighted average of the borrowing cost applicable to the general pool. Okay. And how this capitalization rate is calculated? Weighted average of the borrowing cost applicable to the general pool. Total general borrowing cost for the period excluding specific borrowings. So if there is a specific borrowing, for example, in this question, out of this 4 borrowing, it was written that this Bank of India borrowing was specifically for a construction of a building. In that case, this borrowing should be excluded and remaining 3 borrowing will form part of a general pool. Okay. So total general borrowing cost for the period excluding specific borrowings divided by weighted average total general borrowings excluding specific borrowings is equal to capitalization rate. Now this is a question illustration number 3 from Institute study material. So page number 7.197. Beta Limited had the following loans in place at the end of 31st March 2002. 18% bank loan. So in this question, there is the information which is given for the Beta Limited. 18% bank loan, 1,000. Okay. So at the time of the opening date, this 1000 loan was there. In the closing, this 1000 loan was still there. It means the loan remained outstanding and the loan has not been paid. So why this information is important? This information is important because if the loan has been paid, then there is no point to capitalize the borrowing cost, because what is the fundamental principle? There must be a borrowing, and if there is no borrowing, borrowing cost will not be there. For example, the company was constructing a factory, okay, and it took around 4 years to construct a factory, okay, and the company has taken a loan. When the company has started the construction, the company has taken a loan, but after 1 year the company has repaid the loan, okay. So in this case, the borrowing cost will be capitalized only till the time it is repaid, okay. So for the next 3 years, borrowing cost will not be capitalized. Why? Because there is no borrowing, okay. So of course you need to see whether there is a borrowing lying or not. If the borrowing is not lying, in that case borrowing cost will not be there. So you need to see two things. One, whether the asset has been constructed. If the asset has been completed, so after that borrowing cost will not be capitalized, it will go to P&L. And if before completion of the asset, if the borrowing has been repaid, so after repayment of borrowing, since there is no borrowing, there will not be any cost, there will not be any capitalization, okay. Ambika, is it clear? So this 18% bank loan was lying in the beginning and also lying in the closing. So this loan is outstanding. Again, there is a 16% term loan. Again, 3,000, I mean to say 30 lakhs rupees have been outstanding in the beginning as well as in the closing. There is a 14% debenture, which is not there in opening, but there is into closing, okay. It means this 20 lakh rupees has been taken in during the year. 14% debenture was issued to fund the construction of office building on 1st July 2001. On 1st July 2001, but the development activities has yet to be started, okay. On 1st April 2001, Beta Limited began the construction. So this information is given for 31st March 2002, and during the year on 1st July, there was a 14% debenture. So out of these three loans, if you see 18%, 16%, 14%, so this 14% debenture is specifically used to fund the construction of office building, okay. So this is a case of specific borrowing. Then on 1st April 2001, it means beginning, the construction, Beta Limited began the construction of a plant being qualifying asset using the existing borrowing. So on 1st April 2001, there was two borrowings, 18% bank loan and 16% term loan. So there is a total borrowing of 40 lakhs, which is 4,000, and Beta Limited has started using the existing funds to the construction. Expenditure drawn down for the construction was 5 lakh on 1st April 2001, and on 1st April 2001, out of the existing pool, Beta Limited has used 5 lakh rupees, and on 1st January 2002, Beta Limited has used 25 lakh rupees, okay. So total fund which is used by Beta Limited is 30 lakh rupees, and out of 30 lakh, 5 lakh was on 1st April and 25 lakh was on 1st January, okay. So you are required to calculate the borrowing cost that can be capitalized for the plant, okay. So if you see this question, there are three loans. There are three loans which is given in this particular question, 16%, 18% and 14%. There is a specific information which is given for 14%. That this 14% is for the office building. So it is a case of specific borrowing. And out of the existing funds on 1st April 2001, Beta Limited used the fund for the construction of a plant. It means we are not aware that whether it is from 18% or is it from 16%, whether the entire amount is from 16%, we are not aware, okay. So it means it is a combination of two, okay. So it is a case of general borrowing for the plant, general borrowing for the plant. So what is the first thing? First step, we need to calculate the weighted average cost of borrowing. So what is the first step? Cost of Pujita, what is the first step? The first step is to calculate the weighted average cost of borrowing. Illustration number 3. Illustration number 3, page number 7.197. Illustration 3, page number 7.197 of ICAI study material. So if you see this, what is the step 1? Calculate weighted average cost of borrowing. So how to calculate weighted average cost of borrowing? Weighted average cost of borrowing is equal to total interest divided by total borrowing. Of course, excluding specific borrowing. Excluding specific borrowing. Okay, excluding specific borrowing. So in this question, what is the total interest? The total interest is, what is the total interest? The total interest is 18% on 1,000 plus 16% on 3,000. 16% on 3,000. And what is the total borrowing? I am only talking about the general pool borrowing, which is excluding specific borrowing. What is the total borrowing? Which is 1,000 plus 3,000. So what is the total here? Can any of you calculate? Chavi, can you please calculate this? Okay. So 18% into 1,000 is 180. 180 plus 16% into 3,000 is 480. Divide by 4,000. So what is the rate here? 720. 180 plus 480 is equal to 660 divided by 4,000 is equal to 16.5%. So this is 16.5%. 16.5%. Okay. So now what is step 2? Apply the weighted average cost of borrowing to the funds used. Apply the weighted average cost of the borrowing to the funds used. So in this case, funds are used as, the funds are used as 5 lakh on 1st April 2001. How much amount has been used? 5 lakh. 5 lakh multiplied by 16.5%, and it is for the entire year. So we are talking about the 2001-2. Okay. So this is for entire year. And on 1st January 2002. Is it 1st January? Okay. So 1st January 2002, how much amount has been used? 25 lakh. 25 lakh multiplied by 16.5%, multiply by 3 divided by 12 up to March. So what is the amount here? 5 lakh multiplied by 16.5%. So 5 lakh multiplied by 16.5% is 82,500. 82,500. And here 25 lakh multiplied by 16.5% divided by 4 is equal to 1,03,125. 1,03,125. So what is the total? This is plus 82,500 is equal to 185,625. 185,625. So the capitalization rate is 16.5%, and the amount which is going to be capitalized as a borrowing cost, the amount which is going to be capitalized is 1,85,625 during the financial year 1-2. So what about the remaining amount? So if you see, for the entire year this 1000 loan, was there for entire year. So what will be the total interest? 1000 multiplied by 18% is 18 is 180 is 180 plus 480, basically 660. So out of 6,60,000, 1,85,625 will be capitalized and the remaining will go to P&L. Okay. Any doubt here? Have you understood? What is the total interest cost? Total interest cost is 180 plus 480, 6,60,000. Out of 6,60,000, 1,85,625 will go for capitalization, and 660 minus 185,625 will go to P&L. Okay. Is it clear? Yes or no? Is it clear? Yes or no? Can I move forward? Okay, so let me share my screen again. So this is the answer which is there on the screen again. Now again there is a concept of impairment. So as far as the concept of impairment is concerned, so when the carrying amount or the expected ultimate cost of the qualifying asset exceeds its recoverable amount or NRV, so this carrying amount is written down to the recoverable value. So the same concept of Ind AS 36 will be applicable to Ind AS 23 also. For example, there is a asset cost, let's say machinery. Okay, so I have given you an example. So machinery, there will be a substantial period of time which is used for constructing the machinery or get ready the machinery for its intended use. Okay, so the company has taken a loan for this particular machinery. So in this case, if the government has banned the output which has been taken from that particular machinery, in this case the future economic benefit from the machinery is not probable, and impairment testing is required for that particular machinery. Okay, so in this case, if there is a borrowing cost which has to be capitalized as a part of the cost of the machinery, it has also required to be written down to the recoverable value. Okay, so this impairment concept is the same concept which we have read in Ind AS 16, Ind AS 38, okay, or even Ind AS 36. Now we are discussing period of capitalization. So we will be discussing three concepts: commencement of capitalization, suspension of capitalization, and cessation of capitalization. So far we have understood what is borrowing cost, what is qualifying asset, and we have understood that borrowing cost which is directly related to the acquisition, construction, or production of a qualifying asset is required to be capitalized. But now then we have discussed that what happens if it is a specific borrowing. So what is the amount which is going to be capitalized? What will happen in case of a general borrowing? So what is the amount which is going to be capitalized? What is the component of the borrowing cost? So we have discussed all this stuff. Now the question arises, sir, from when the borrowing cost is required to be capitalized? From when? For example, the company has taken a loan on 1st April 2001. Okay, the company has taken a loan on 1st April 2001, but the asset under development or the asset which is subject to development has been acquired on 1st September 2001. Okay, the loan has been taken on 1st April 2001, and the asset has been acquired on 1st September 2001. So sir, whether the borrowing cost has started from 1st April 2001. So do we capitalize this borrowing cost from 1st April 2001 or from 1st September 2001? So we need to see what is the commencement date for capitalization. The standard says that the borrowing cost is required to be capitalized from the commencement date. And what is the definition of commencement date? Standard says that commencement date means the date when the entity meet the three conditions in entirety. Entity meet the three conditions in its entirety. If you think in my example, if on 1st April the loan has been taken, लेकिन asset कब आया है? Asset आया है 1st September को. So it means if the company capitalize the loan interest from the 1st April, it would not be going by the substance, it would not be correct. It will not show a correct picture. क्योंकि जिस asset पे मुझे capitalize करना है उस loan के interest को, that asset is not there. Okay. So standard says that the interest on loan is required to be capitalized as a part of the cost of particular asset from the commencement date. And what is commencement date? Commencement date क्या होती है? Commencement date is a date when the entity met three conditions. When the entity met three conditions. What are the three conditions? What are the three conditions? Three conditions are: first condition, borrowing should have been made. Borrowing should have been made. First condition. Second condition, expenditure for the asset has been incurred. Expenditure for the asset has been incurred. Third condition, activities that are necessary to prepare the asset for intended use or sale have been started. So these three conditions should be satisfied. Now, I'll explain with the help of an example. Okay. So we discussed that the borrowing cost is required to be capitalized from the commencement date. Okay. So the commencement of capitalization will be done from the commencement date. Now the question arises that what is the commencement date? So it says that the commencement date, CD, I will call it as a CD. The commencement date is a date when three conditions will be met. What are the three conditions? Borrowing made. The borrowing has been done. The loan has been taken. Second, expenditure on asset has been incurred. Third, activities necessary to bring the asset, into the intended use or sale has been started. For example, the company wants to develop a land. Okay, the company wants to develop a land and the company wants to construct some bungalows, flats, and want to sell this bungalows and flats. Okay, so the company will not sell the land, the company will sell the flats, the company will sell the bungalows. Okay, so on 1st April 2015, the loan from SBI has been made. Okay, the loan from SBI has been taken on 1st April 2015. But the company has acquired a land. The company has acquired a land on 1st September 2015. The company has acquired a land. The company has acquired a land on 1st September 2015. Okay. Now the activity has been started. So what is meant by activities? Activity includes technical activity as well as administrative activity. For example, for construction, the company needs to get a plan, to get a map or to get a plan sanctioned from the authorities. The company needs to get some licenses from the authorities. The company has to prepare a complete architecture for that. Okay. So the company has started incurring those kind of expenditure. Okay. So it does not mean expenditure means the construction work has been started. It means even though the company has applied for the licenses, the company has applied for the sanctioning of map, design, even that will also include under activities necessary to bring the asset into the intended use or sale. Okay. So on 1st April 2015, loan from SBI has been taken. On 1st September 2015, land has been acquired, and on 1st October 2015, the company has started applying licenses or engaging architecture for the finalization of map. Okay, so this map, design or architecture activity have been started. Now, my dear students, so Chavi, Pujita, Ambika, Kaustav, Shreyansh, Shreya, Nanda, you have these 3 dates. Now tell me, what is the commencement date and from when the interest is going to be capitalized? From when the interest is going to be capitalized? Tell me fast. Okay, so Chavi is saying sir 1st September 2015. Ambika is saying 1st October 2015. Anyone else? Pujita is also saying 1st October. Shreyansh is also saying 1st October. Shreya is also saying 1st October. Okay, so guys, please see 3 conditions. What are the 3 conditions? Commencement date is a date when 3 conditions will met. So what are the 3 conditions? Borrowing has been made, which has been taken on 1st April. Expense on the asset has been incurred, which is on 1st September, and the activities has been started, which is could be technical activity, administrative activity, which is 1st October. So 1st October 2015 is the date when these 3 conditions will be satisfied. And hence the interest from 1st October 2015 is going to be capitalized. Sir, then what happens for the interest between 1st April and 1st October? The interest will go to P&L. Okay, it will go to P&L. Let's do a case study from the Institute study material to understand this once again. So this part we have covered. So expenditure on a qualifying asset include those expenditure that have resulted in payment of cash. Okay, so it should not be a notional expenditure. It should be an actual expenditure which has resulted in cash, or it could be a situation where one asset has been taken and the other asset has been transferred, exchange of assets. You remember we have discussed the concept of exchange of assets. Assumption of interest bearing liabilities. Expenditures are reduced by any progress payments received and grants received in connection with the asset. What is meant by activities? It includes technical and administrative work prior to the commencement of physical construction. So physical construction is not only important, even before the physical construction, some licensing is required, some map is required, some authorities approvals are required. So even the technical and administrative work has been started. It is suffice for substantiating the activities. It excludes the holding of an asset when no production or development that changes the asset's condition is taking place. Okay. Illustration number 4. Is it visible on the screen? Illustration number 4, commencement date. Illustration number 4, page number 7.200 of Institute study material. Is it visible? X Limited is commencing a new construction project which is to be financed by borrowings. The key dates are as follows. Okay. On 15th May 2001, the loan interest relating to the project has started to be incurred. It means 15th May 2001 is the date when the company has taken a loan. Okay. On 2nd June 2001, the technical site planning commences. It means the activity has been started on 2nd June 2001. And on 19th June 2001, the expenditure on the project has been started to be incurred. And the expenditure has started to be incurred on 19th June. On 18th July, physically the construction work has been started. So you are required to identify the commencement date. My dear students, what is the commencement date in this particular question? What is the commencement date in this question? So borrowing cost has been incurred on 15th May. Expenditure has been incurred on 19th June. And activity which is necessary to prepare the asset for intended use or sale has been started on 2nd June. So what is the common date when all the three conditions are satisfied? What is the common date when all the three conditions are satisfied? So Ambika, there is no such date as a 1st June. So what is the common date? So the common date when the three conditions are satisfied is 19th June 2001. Shreyansh, 18th July is not a right answer. Why? Because on 18th July, the construction work has been started, and I have told you that the construction work is not important. Even the technical and administrative work has been started, so that is suffice to meet the condition for the commencement date. Okay. Okay. Yes, Nanda, Kaustubh, Chavi, Ambika, Pujita, you all are right. 19th June is the right answer. Okay. Now we are discussing the suspension of capitalization. You remember, I have told you three concepts. Commencement of capitalization means when the capitalization of borrowing cost will start. Second, suspension of the capitalization. So whether the borrowing cost will be deferred or will be postponed if the active development of a qualifying asset is suspended. So this COVID situation was a classic example when the lockdown has happened in the country and there was no construction activity for the next for the 2-3 months. Okay. So even there was a guidance which is issued by ICAI under Ind AS that whether if the active development of the asset has been interrupted, active development of the qualifying asset has been interrupted. So whether this borrowing cost is required to be capitalized, still required to be continued as a capitalized, or it is required to be charged to P&L. Okay. It is required to charge to P&L. So friends, standard says that capitalization of borrowing cost shall be suspended during the extended periods in which it suspends active development of a qualifying asset. Okay. An entity also does not suspend capitalizing borrowing cost where a temporary delay is a necessary part of the process of getting an asset ready for its intended use or sale. For example, capitalization continues during the extended period that high water level delays construction of a bridge if such high water level are common during the construction period in the geographical region involved. Sir, समझ नहीं आया, no worries. Suspension of capitalization. Suspension. Suspension means deferment or postponement. Suspension of deferment. Okay, suspension of deferment. So it says that the borrowing cost, the capitalization of the borrowing cost has been suspended. If the active development if the active development of borrowing cost, active development of qualifying asset is hampered or interrupted. For example, the company was constructing a factory. The company was constructing two factories. Factory number 1, which is F1, and factory number 2, which is F2. Okay. So the company was constructing two factories, F1 and F2. So the company has taken a crane on lease. Okay. So this is a crane, and the company has taken a crane on lease. Okay. So this is a crane which is taken by the company on lease, and this crane is used for the construction of this particular of this factory. Now this crane has been shifted. To another site. Which is F2. Okay. For the next 3 months. And due to shifting of this crane, the construction of this factory has been stopped. Due to shifting of this crane, the construction work of the factory or the active development of the construction has been stopped, has been interrupted. So in this case, standard says that if the active development of the qualifying asset has been interrupted, so for this particular 3 months, the borrowing cost will not be capitalized and it will charge to P&L for this 3 months. And when the full-fledged construction activity will started, in that case, it will go for capitalization. Okay. Second example. The company was constructing a factory. And the labor goes on strike. So there were so many labor which was involved in the construction of the factory, and the labor goes on strike for 2 months. Okay. So in this case, the labor goes on strike and the work has been stopped. So in this case, for this 2 months, the borrowing cost will require to be charged to P&L. Third example. Whether COVID was a normal situation, COVID was abnormal situation. Me, you, and even no one has expected around of this world. No one has expected that this kind of pandemic will be, arise in 2020 or 2021. Okay. So this COVID was unexpected, and due to COVID, the lockdown was happening across the world. Okay. So even in India, this construction activity has been hampered for 3-4 months due to lockdown or due to social distancing or due to this COVID thing. Okay. So when this COVID situation has started and the active development has been interrupted or stopped, in that case, for that particular period of 2-3 months, the borrowing cost should go to P&L, and the borrowing cost should not be capitalized. The capitalization of the borrowing cost should be suspended, deferred, postponed. Okay. But the standard has given some exceptions. What are the exceptions? The standard says that if the delay or if the interruption of active development of qualifying asset is a normal part of the process. For example, the company is constructing a road. The company is constructing a qualifying asset. Okay. And it is requirement of it is a regulatory requirement that when the company will complete the first phase, the company has to obtain a license for the second phase. Okay. So the government will only provide the license for the second phase after inspection of the first phase. Okay. And normally it will take 3-4 months. Okay. For getting the license, it will take 3-4 months. And between these 3-4 months, the active development has been hampered or interrupted. So in this case, obtaining a license is part of the process, which is already known with the company. Okay. So in this case, even though the active development has been stopped or interrupted, still the borrowing cost is required to be capitalized. Second example, for example, in case of Cherrapunji or Mysore, in case of Meghalaya, where there are heavy rains. Okay. So for example, if the company is constructing a bridge constructing a dam in Delhi or Mumbai, let's say it will take 2 years. So in the rainy areas or in the hilly areas, it will take around 3 or 4 years. Okay. So in the entire year, 6 months, there is heavy rain. Okay. So the work has been hampered in this 6 months, and the work has been executed only in the next 6 months. Okay. So in this case, this heavy rain is part of this delay is part and parcel of the project. Okay. Because you cannot ignore this 6 months delay. You have to factor this in mind because it is a part and parcel of the project, and hence in this case borrowing cost will not be suspended and it will be capitalized even for the period when the active development has been hampered. Okay. So guys, is it clear to you or not clear? Is it clear when the when the borrowing cost has been suspended or when the borrowing cost has not been suspended? Is it clear? So again, I am reading this particular slide again. Please read this slide. Capitalization of the borrowing cost shall be suspended, postponed, or deferred. Okay, shall be suspended during the extended periods in which it suspend the active development of a qualifying asset. Okay, an entity also does not defer capitalizing borrowing cost when the temporary delay is a necessary part of the process of getting an asset ready for intended use or sale. For example, I have given you an example of government license. I have given you an example of the natural conditions. For example, the capitalization continues during the extended period that high water levels delays construction of a bridge if such high water levels are common during the construction period in the geographical region involved. Okay. So Ambika, in example number 1, for example, there were two factory 1 and factory 2. Okay. So there was a separate capitalization of borrowing cost in factory 2. There was a separate capitalization of borrowing cost in factory 1. Okay. So if the active development of the factory 1 has been interrupted, so the thing is the period in which the active development has been interrupted or active development has been suspended. So for that period, borrowing cost will not be capitalized. Okay. It should not be the case that for that period the factory 1 borrowing cost should be charged to factory 2 borrowing cost. It should not be the case. So we are only talking about the situations where there could be extended period of delays. Okay. Cessation of capitalization. So we discussed commencement of capitalization, then we discussed deferment of capitalization. Now we discuss stopping of capitalization. Stop the capitalization. What does it mean? So it says that the capitalization is stopped when substantially all the activities necessary to prepare the qualifying asset for its intended use or sale are complete. For example, you must have seen that in case of school or colleges, even the school and colleges have been constructed. The furniture and fixture work is going on, and the whitewash work is going on, the painting work is going on, but the classes has been started, the computer lab has been started, library has been started, classes has been started. Okay. So what does it mean? It means if the activity necessary to prepare the qualifying asset for intended use or sale are substantially completed, let's say more than 90% it is ready for use. Okay. The only thing is finishing work is going on. The only thing is this whitewash, painting, furniture fixture, this work, interior work is going on, but the asset is ready for use. Okay. So if the asset is substantially ready for intended use or sale, then the borrowing cost should be stopped. Okay. Or if the borrowing cost is into parts, for example, the company has started the construction of 4 parts into a campus. So there is a residential building. Let me take you on this whiteboard first. So cessation of capitalization. Cessation of capitalization. Means stopping the capitalization. So when this capitalization will be stopped, it will be stopped when the qualifying asset is substantially completed. Substantially completed. Okay. For example, when you purchase the house, so normally you take the possession of the house, you started living in the house, and the furniture work or interior decoration is going on when you are living in the house. So technically speaking, this house is ready for intended use or sale. It is substantially completed. So when the asset is substantially completed, the borrowing cost should be stopped for capitalization, and after that it will go to P&L. So Kaustav is asking, sir, what happens if the completion of qualifying asset happens in the stages? Okay. So of course, Kaustav, we have to capitalize the borrowing cost till the time it is substantially completed. Now, if the borrowing cost is into parts, okay, and it is, and the every part is independent part. For example, there is a ABC Limited which is developing a campus, okay, and that campus includes residential building. This campus includes a shopping mall. This campus also includes a school. Okay. So these are the three parts, these are the three blocks which is developed by this company ABC Limited, and every part is an independent part and they can operate independently even though the second part is not ready. Okay. So if the residential building has been ready, if the residential building is ready for use or ready for sale, in that case, in this part, the borrowing cost should be stopped. In this part, the borrowing cost should be stopped. And if the mall or school is under construction, the borrowing cost is continue to be capitalized in this mall or school. But the borrowing cost on the residential building is required to be stopped. And after that, it will go to P&L. But what happens if all these are interdependent? For example, in case of a steel mill, in case of a power plant, in case of a steel plant, there are a lot of machineries, or there are a lot of plants which are interrelated, like your sinter plant, like your plate mill. So everyone is interrelated. Okay. For example, there is a factory. Okay, where multiple assembling units are there, or multiple plants are there, and all the plants are interrelated. Okay, these are interrelated. For example, this one has been completed, this one has been completed, but this will of no use until this will be completed. Okay, so in this case, the borrowing cost will not be stopped even though the first two parts are ready. So you need to see if these are independent, then the borrowing cost on that particular part is required to be stopped. If these are dependent, then borrowing cost is required to be stopped only when the entire parts have been substantially completed. Okay. Any doubt here? The cessation of capitalization, is it clear? Friends, is it clear or not clear? Okay. So substantially completed means, for example, you have seen in the societies or in case of real estate developer, when you go to see the flat, so they will stop the furniture and fixture work. They will say, if you are buying a 2-bedroom flat, so they will say, I'll give you one almirah. So it is your choice whether you want to have almirah in the first room or in the second room. Okay. So normally these are kind of a marketing strategy which they put on hold. Otherwise, they have completely constructed the entire flat. Okay. For example, wooden flooring. So they keep these things open for the wish of customer. If you want to have a wooden flooring in the first bedroom or in the second bedroom, we will do that. Okay. But we will give wooden flooring in the one bedroom. So these items, these things are only pending. Otherwise, the works have been substantially completed. So in this case, the borrowing cost is required to be stopped to be capitalized on that particular asset. Okay. So cessation of capitalization, again, please read this particular slide. The borrowing cost will be stopped when substantially all the activities necessary to prepare the qualifying asset for its intended use or sale are complete. When an entity completes the construction of a qualifying asset in parts and each part is capable of being used while construction continues on other parts, the entity shall cease capitalizing borrowing cost when it completes substantially all the activity necessary to prepare the part for its intended use or sale. Please remember the example of residential building, mall, and school. Okay. So if it is dependent, please remember the example of power plant or steel plant. Okay. So let's do this question. This is the last question from the Institute study material. Test your knowledge. Any query so far? Any challenge in understanding any concept? Ambika, any challenge? Kaustav, any problem? Pujita, Shreya, Shreyansh, Nanda? Yes. So page number 7.204. Question number 2. Test your knowledge. X Limited has a treasury department that arranges the funds for all the requirement of the company, including funds for working capital and expansion programs. During the year ended 31st March 2002, the company commenced the construction of a qualifying asset and incurred the following expenses. On 1st July, the company has expensed 2,50,000. On 1st December 2001, the company has incurred 3 lakh rupees. Okay. The detail of the borrowing and interest thereon are as under: long-term loan at the rate of 10%. The average balance is 10 lakh and the interest is 1 lakh. Working capital loan, the average balance is 5 lakh and the interest is 65,000. So the total loan is 15 lakh and the total interest is 1,65,000. You are required to compute the borrowing cost that needs to be capitalized. Very simple. So what could be the answer for this? See, first of all, you need to calculate the weighted average cost of capital, weighted average cost of borrowing. So what is the weighted average cost of borrowing? 1,65,000 divided by 15 lakh. 1,65,000 divided by 15 lakh gives you 11%. Okay, so 11% is the weighted average cost of borrowing. Now, so the company has incurred 1st July 2,50,000 from 1st July. It means from 1st July to 31st March, how much period is there? 9 months. So for the 9 months, this interest is required to be capitalized at the rate of 11% on 2,50,000. And 3 lakh has been incurred on 1st December. For the 4 months, the 11% interest is required to be applied on 3 lakh. Okay. So let me show you the answer also. So the capitalization rate is total borrowing cost divided by weighted average total borrowing, which is 11%. On 250 at the rate of 11% for 9 months. On 3 lakh, it is 11% per annum for 4 months. Okay. As far as disclosure is concerned, so of course, amount of borrowing cost capitalized during the period. If the company has capitalized any borrowing cost, it is required to be disclosed in the notes to accounts. And what is the capitalization rate used in case of general borrowing? This is also required to be disclosed. So friends, now it's a Maggie time. So let's enjoy the Maggie time. What is the Maggie time? Are you guys enjoying the Maggie time? So what we have learned, we have started this concept of borrowing cost, which is an asset related standard. Okay. And it talks about the main principle, which is borrowing cost, which is directly related to the acquisition, construction, or production of a qualifying asset is required to be capitalized. Other than this, all the borrowing costs are required to be charged to P&L. Okay. Then we discussed that the borrowing cost is only capitalized for the actual borrowing. It is not on the notional borrowing. It is not on the notional cost of capital. It is not on the cost of capital. Okay. Then we discussed this borrowing cost standard is not applicable on biological asset under Ind AS 41. and it is not applicable on the inventories which are manufactured in the large quantities and on repetitive basis, and even though it takes a substantial period of time. But if it is a customized inventory, made to order inventory, in that case it will be applicable. Please remember the example of Maruti cars and modified cars by Dilip Chhabadia. Okay. Yes. So friends, then we discussed what is meant by borrowing cost. Then we discussed borrowing cost is interest cost as per effective interest rate. So what is effective interest rate? Technically, effective interest rate includes all the interest plus all the ancillary cost. Okay, it is a bridge between the inflow and outflow, which you have read and understood in Ind AS 109. Then we discussed if the company is using some leasehold asset in the qualifying asset, so interest on lease obligation is also going to be capitalized. Then we discussed if the company has taken some foreign currency borrowing, then exchange loss is also required to be capitalized to the extent it is regarded as an adjustment to interest cost. Okay. Please remember illustration number 1, which is very important. So we identify the borrowing cost. Then we discussed qualifying asset. What is a qualifying asset? Qualifying asset is an asset which takes a substantial period of time for getting ready for intended use or sale. The word intended use or sale is very important. In exam, a question may be asked where it is written that the asset when acquired by the management is ready for use or sale, but the intention of the management is to develop that asset. Please advise in the light of the provision of the standard whether it is qualifying asset or not. Then you need to write that the definition of qualifying asset is an asset which takes a substantial period of time for getting ready for intended use or sale. Since as going by the intention of the management, it will take a substantial period of time and hence it is a qualifying asset. You need to ignore the fact that the asset when acquired, it is ready for use, because the intention of the management is to develop the asset and hence it will become a qualifying asset. Okay. Then we discussed in case of specific borrowing, we will calculate the actual cost of borrowing less temporary income out of the surplus funds. If it is a general borrowing, then we have to apply 2 steps. Step 1 is to calculate the weighted average cost of borrowing, which is total interest cost divided by total borrowing. Then we have to apply this weighted average cost of borrowing to the funds used out of that borrowing for that particular period. Okay. Then we discussed recognition part also, that the borrowing cost is required to be capitalized and recognized if the future economic benefit is probable and cost can be measured reliably. Then we discussed that the borrowing cost needs to be capitalized to the qualifying asset. Then we discussed the period of capitalization. We discussed commencement date. Commencement date is the date when 3 conditions will be satisfied at a common date, which is loan has been taken, expenditure on the asset has been incurred, and activities necessary to bring the asset as per intended use or sale has been started. So from the commencement date, borrowing cost is required to be capitalized, and before the commencement date, borrowing cost is required to be charged to P&L. Then we discuss suspension of the capitalization. If there is a suspension of the capitalization, so in case of what is suspension of the capitalization? Borrowing cost is required to be deferred, postponed, or suspended for the extended period of delays when the active development of the asset has been hampered or interrupted. So we have given so many examples. But if the delay, extended period of delay is part and parcel of the completion of the project, in that case it will not be postponed or deferred. The borrowing cost should be continued to be capitalized. Then we discuss cessation of capitalization. This capitalization should be stopped when the asset is substantially completed, and if the capitalization is into parts, okay, like school, mall, and your residential building, and each part can operate independently, then the borrowing cost should be stopped on that particular part if that part is substantially completed. But if all the parts are dependent part, in that case, when this entire thing has been substantially completed, till the time, borrowing cost should continue to be capitalized. So this was all from my side. Thank you very much, and let me know if you have any query. Let me know if you have any queries. So Ramya, in this case, if the holding company has taken a loan and the holding company has given that loan to the subsidiary company, and subsidiary company is of course using that particular loan as a for the construction of the asset. So if the subsidiary company is paying an interest, in that case, this loan is required, this interest is required to be capitalized. Okay. So in the standalone books, you need to see, for example, if the holding company has taken a loan and holding company has made some investment in the subsidiary, and the subsidiary is using that money for that particular construction, in that case, it will be like a cost of capital. Okay. Because if the subsidiary company holding is investing, that it will become an equity of the subsidiary. And of course, cost of equity is not allowed. Okay. But if the holding company has taken a loan and holding company has given a loan to the subsidiary and subsidiary is also paying an interest, in that case, it will be capitalized. So thank you, friends. Thanks, Chavi, Kaustav, Pujita, Shreyans, for your feedback. Thank you so much. Any query? If there is any query, we can discuss. Otherwise, I will finish the session. So we'll wait for another 1 or 2 minutes. So let me know if you have any queries. So your homework is you have to go through with the entire study material on this Ind AS 23. So largely we have covered all the question, hardly 1 or 2 questions may be left, but largely we have covered all the practical issues or question of the study material. So you have to go through with this study material on Ind AS 23. It's a very small standard. So it will take another half an hour or 1 hour if you have to revise this particular standard. So I would request that you need to revise this standard from the study material. So if possible today or tomorrow for sure. Okay. Thank you very much. So there is no any query and everyone is saying well understood. Thank you so much. So stay safe, stay happy. Thanks.